Okay, so you want to get smarter about money, but, who has the time for endless reading?
Exactly. People are busy.
So we've done the work. We dug into this business world piece, 5 financial traps to avoid in building wealth. The goal here is basically a shortcut.
hmm We're pulling out the absolute must-knows to help you skip some potentially really costly mistakes.
Think of it as a financial heads up. We're focusing on 5 biggies from the report.
Yeah, things like high-interest debt, lifestyle inflation, not having an emergency fund.
Investing without a real plan and skipping insurance. Stuff that seems basic but catches so many people out.
Definitely. It's about avoiding the pitfalls.
All right, let's dive into that first one. High interest debt.
Right.
You mean those credit cards where the balance just never seems to go down, or like payday loans?
Oh, those are killer. And even some car loans, the double-digit interest ones.
Yeah. The business world piece really hammers home how that compounding interest just, well, eats away at your wealth.
It's like a leak, right? A slow drip draining your money. The report mentioned how quickly it snowballs if you're only making minimum payments.
You end up paying mostly interest. Takes forever.
Decades, sometimes.
Yep.
It highlights things like the debt snowball or avalanche methods to prioritize which debts to hit first.
And practical steps. The piece talks about like balance transfer cards, those 0% intro offers.
Good option sometimes.
hmm
Or maybe consolidating with a personal loan to get one lower fixed rate.
Anything to stop that high interest, basically.
Okay, next trap. Lifestyle inflation.
Ah, yes, the more money, more spending cycle.
Exactly. You get a raise, and suddenly you feel like you need the fancier car or the bigger apartment.
Instead of, saving or investing that extra cash.
Right. The Business World article points out you're just sort of running in place financially if your spending keeps up with your income.
You feel richer, maybe, but you're not actually building that long-term wealth. The document brings up the 50-30-20 rule.
Yeah, the guideline. 50% needs, 30% wants, 20% savings and debt paydown.
A good framework.
And a key tip they mention is automating your savings. Set it up so the money goes to savings or investments before you even see it.
Treat future you like a bill that has to be paid first.
Then you figure out the fund money.
Okay, trap number 3 from the report. No emergency fund.
This one's crucial.
Because life throws curveballs, right? Medical bills pop up, you might lose a job, the car breaks down.
And if you don't have that cash cushion, the Business World piece says you're likely heading straight for more debt, probably high interest debt again.
Vicious cycle. So the recommendation is what, 3 to 6 months of living expenses?
Yeah, and something safe and easy to access, like a high-yield savings account.
But that sounds daunting for some people.
Well, they also stress starting small.
Mm.
Even just $500 is a start. It
Right.
stops you from immediately reaching for the credit card for, a smaller emergency. Then build it up.
Reduces stress too, knowing you have something. Okay, 4th trap. Investing without a plan.
Ah, the temptation of the hot tip.
Yeah, chasing meme stocks, crypto crazes, get-rich-quick stuff without really doing your homework.
The Business World piece warns against that. Remember all the hype around stocks like GameStop or AMC?
Oh yeah, a lot of people jumped in late
And lost money when it crashed. The article really pushes for a steadier approach. Think low-cost, diversified index funds.
like S&P 500 ETFs, that kind of thing, buying a tiny piece of lots of companies.
Exactly. It's about consistent growth over the long haul, not trying to time the market.
And making sure it fits your own goals and like how much risk you're comfortable with. Spreading the risk is key.
Definitely. Okay, final trap. Ignoring insurance.
Seems like an easy place to save money, maybe. Just skip it.
But the Business World document calls that out as a huge risk, potentially devastating.
Yeah, imagine a massive medical bill with no health insurance.
Mm.
Or a house fire with no home insurance. Wipes you out.
Totally. So the essentials are health insurance, term life insurance if people depend on you, and definitely home or renters and auto insurance.
Basic protections against financial catastrophe.
And they also mention things like HSA's health savings accounts or disability insurance as extra layers depending on your situation.
So, wrapping this up, the big takeaway from this business world piece seems to be, well, avoiding the big mistakes is maybe even more important than earning more money.
I think that's spot on. It's often about defense. Get rid of that bad debt, live below your means, build that emergency fund cushion.
Invest consistently and with a plan, and make sure you're protected with the right insurance.
Nail those basics, and you're building on a much stronger foundation.
So here's a final thought for you listening. Out of those 5 traps, the debt, the lifestyle inflation, no emergency fund, random investing, ignoring insurance. Which one maybe feels most relevant to your situation right now?
Yeah, just reflect on that. And maybe think about one small thing, one concrete step you could actually do today or this week to start tackling it.
Even just researching an option counts, right?
Absolutely. It's about starting.
If you found this discussion informative, please like, subscribe, and share this channel to get daily discussions on a current economic topic.